Hello, folks. Mark here from Flipside Trading, and here we are to discuss the trades of the week of April the 13th. The first thing to notice is that, hey, we took one trade, but we were profitable, right? Went ahead and expired worthless, no sweat trade. It kicked our overall earnings to over 17,000 for the year. At the same time, our average weekly profit is still over $1,200. So, what I really want to talk about today is number one, the mechanics and the reasons and the triggers of why we took the SPX trade, but more importantly, why we did not play the market on an overnight basis for the last couple of days. Okay, and that's why we're saying that cash is definitely a viable position. All right, let's go take a look under the hood and see what we got. Let's go here. Let's get back. All right. Here we are. We're looking at the SPX. All right. It's Tuesday now. We're looking kind of in this time frame. We're right here. We have an inside bar. Let me give you a better arrow for that. We got an inside bar right here. And it looks like the market is forming a bottom because we have one bottom here, forming this bottom, and we're respecting this trend line and the 200-day moving average. So in general, you would think you're bullish. However, you look at this inside bar, you can see that price was rejected and it got pushed down. So we're looking at a Wednesday, options expiration. So we want to see what happens on Tuesday. Well, what happened is we got this huge gap up, and we got it gapped up above the ADMA, which is very, very bullish, right? Anytime that you gap above a resistance level, and in this case, the ADMA serves a resistance, it's a very, very bullish sign. So let's go ahead and take a look at how we then took the entry once we knew that we were above the ADMA. So that will go down to the lower time frame, and here we are in the 5-minute, and here we can see right here, this is the morning of April the 10th, the day that we actually posted the trade, and you can see that here we gapped up, right? This is above the 8 EMA on the daily, and we ran into this consolidation. So the key is if we break this consolidation, then that tells us that we're bullish, to give us a bullish direction impetus to go ahead and take the trade. And that's exactly what happened. You can see here that this candle broke through pretty close to 8:30. We went ahead and texted out this trade at 8:35, and we went ahead and we'll go back and we'll say, okay, now that we're bullish, where do we set the short strike? So let's go back to the daily. Well, we'll go back to the daily. We definitely want to have what I call protective support. Well, we have protective support here. Let's make this a little bit bigger so we can see. There we go. We got some protective support right here, which is the ADMA, which is that yellow line. We also have the 200 moving average right here. So we definitely want to put it underneath those two pieces. And if you look, there's definitely a support. It actually comes all the way back here. A support line back here. So if we put it down here at 25.85, which is a good 70, 80 points away, gives us enough cushion, gives us enough support, and of course the next day, the ADMA held. We had the FOMC minutes, so the market was kind of stable for a while. And this expired worthless, right? We closed here at this point in time. Let's see, we closed this day. Let's see, the close was 26.42, and we had 25.85 short strike. So we're basically 57 points away. So no sweat, we're able to get it and get max profit of $375. Now the bigger question. Why didn't we take any trades after Wednesday, right? Because usually Friday expiration is a big day for us. We place 3 or 4 trades. Well, a couple things are happening. One is geopolitical, right? That's Syria. We had the chemical weapons attack. We're attributing that to Syria and Russia. The whole idea is that we're going to retaliate from a military perspective, and if we do that, well, Trump goes ahead and he starts getting up a diplomatic Twitter storm, and starts talking about our shiny missiles coming, at Russia. Of course, Russia responds with, "Hey, if you shoot missiles at us, we're going to shoot those missiles down, and we're going to take out, basically the ships or planes where they emanated from." So now the market is on edge, and every time there's a little bit of conversation, you can see that the market is jittering down, right? It's not closing high. Even though we have increasing momentum, I keep getting that instead of the arrow. Even though we have increasing momentum here, we keep right at the day's close, it could push down, push down, push down, push down. So the concern was that if we do have a geopolitical event that happens overnight, and the market gaps down because we increase tensions as a potential escalating conflict with the Soviet Union, there's no way we can recover for that. So the best thing to do is to stay out of the market. In addition, there were some other things going on, and that has to do with President Trump and just everything he's mixed up in, from extramarital affairs to the potential Russian collusion. There was just news breaking every single day between Comey, the search of his lawyer's office, Cohen. So the best thing to do when you can see the market is jittery and you do not want to be caught, cash is a great position. Remember, our number one premise, right, and promise to ourselves is to retain capital. Because if you don't have capital, you can't play in the market. So we sat it out. And what we did is we just kind of stayed more or less with some day trades, which were just too fast for the trading service. But I do want to get an idea. We'll kind of give you a quick shout on what a day trade looks like, just in case you're interested. So we'll go ahead and clear that, and we'll show you what we got. So let me bring this over. All right. I'm in a chat room with a bunch of other traders, and you can see here that the other morning I said on April the 11th, I said, hey, the overnight pricing was 100% net short, which puts the market out of balance. So this means when it's out of balance, the market wants to come back to balance. And there's a high probability that it's going to come back, and we're looking for a bounce at the beginning of the day. We even called out a target. And so I said, all right, let's take a watch and see whether or not we get a trigger. And I said that people are asking, how do you know? You can see it here. And I posted the actual charts later on. So let's take a look at the charts. All right, you can see here, this was the close the night before. And all this is underneath, right? All the way up to the market open the next day is underneath 26.53. It's all downward. This is what I'm talking about, the market being out of balance. Now we have the ADMA here. When price is below, it serves as resistance. This is our trigger. We break through, get a little pullback, and the break of this high is where we enter. This is where we post, right? You saw the post. I showed it to you there. And we said the target is going to be this line here, 26.44. Well, why 26.44? Because 26.44 was the overnight high, right? Right here, where we came on to the 11th, right in through here, this was the high. So we took this high, and that was our target. Sure enough, it popped through. We looked at momentum looking at momentum is moving up. It always gives me the box, never the arrow. Right, momentum's moving, but we have our moving average stack, which is overall bullish. We have our CCI indicator here, which is showing positive strength. And so we take that trade, and we pick up a good 6-7 points. And that's what you do when the market is very volatile, remaining cash. You go much shorter term, and you do some day trades. All right, folks, that's it. We'll talk to you next week. Catch you on the flip side. Talk to you soon.